What are the similarities and differences between stocks and bonds? Well, first, it is important to understand what stocks and bonds are. Let's start with stocks. Meet Julian. Julian needs $50 million for the expansion of his nuclear company. One way Julian could get this money is by selling stock in his company. What is selling stock? When Julian sells stock in his company, he is creating Nefarious Industries Company stock. This company stock can then be purchased by investors. The stock represents a claim of ownership of the assets and earnings of a company to the investor. When Julian goes through with selling stock in his company, he loses sole ownership because now a part of it will belong to the stockholders as well. This could be regarded as a negative consequence of selling stock. It is up to Julian to decide how much stock he wants to sell. He must balance how much he sells in order to raise enough capital while not risking losing too much ownership. In order to actually sell his stock, Julian has some options. He can go public, sell to small and large private investors, or sell to employees of his company. In all scenarios, Julian needs to make his business appealing to his investors. Julian will want to ensure that before offering up his company's stock, his company's fundamentals are good, or in other words, he will want his business to look solid. If it does not, investors will be afraid of purchasing his stock. In conclusion, Julian can get the money for the expansion of his company by selling pieces of his company to other people. The value of the stock can increase or decrease depending on the demand from the investors. So simply put, a stock is a claim on a part of a company's assets and earnings that signifies ownership, and the stock market is simply a system that facilitates the buying and selling of stocks. And then there are bonds, a completely different way Julian could raise $50 million he needs to expand his company. If Julian wants to retain complete ownership over Nefarious Industries, he can sell bonds to investors by working through a broker who will serve the purpose of connecting Julian to an investor. Julian will have to make annual payments until the bond reaches maturity, which is when the loan is fully paid off. In exchange, the investor offers immediate funds to build the nuclear plants. A bond facilitates debt. Julian and the investor agree to set a date of 25 years that the loan will be paid back, plus interest. Interest is the cost of debt. Every year, Julian will pay back $2 million of the loan. The additional interest he will pay each year is $500,000. Thus, the total interest the bond offers is 10% of the original price over the 25-year maturing period. This interest rate, like the time, is also fixed from the beginning. So in total, he makes annual payments of $2.5 million to the investor. For the investor, the bond is a steady stream of income. Every year, he gets a portion of what he loaned plus interest. But say Julian has a problem somewhere down the line with his company. The nuclear power plant explodes. Suddenly, Julian is not making money, so he defaults on his annual payments. Simply put, he cannot pay them. Now the investor is out of luck. He has not been paid back. This is where the risk comes in. Although they are typically safe, there's still a chance to be taken that the bond will not be paid back. In summary, a bond is a debt investment in which the investor loans money with a fixed interest rate and fixed end date. So what are the similarities and differences between stocks and bonds? Well, stock is a form of equity where the stocks raise money by distributing shares in the company, while a bond is a form of debt where Julian, the issuer, owes the holder in a debt he must pay back plus interest. And unlike bonds, stocks have a centralized trading system, the stock market. Bonds are also considered to be safer investments for investors because they're fixed rate of return. Stocks, though, are more riskier for investors because they're still taking a chance on the market. If there's more demand for a stock, it will rise in price, which is good for investors in the company. But if there's less demand for the stock, then it will lose value, which is bad for investors. Also with stock, Julian no longer has complete ownership of the company since he now shares it with his shareholders. But with a bond, Julian has complete ownership of the company. As for the similarities, both are forms of securities. At the heart, they're both investments. So now Julian has these two options, bonds or stocks. Either way, Julian will be able to build his nuclear power plant, but what decision is best for Julian?